Good evening, ladies and gentlemen. Thank you for joining us this evening for this webinar. Tonight, we have with us our fixed income manager, Mr. Ang Chung Yuh, who will share with us the team's thoughts on recent developments, highlight the outlook for fixed income markets, and review investment ideas from the latest edition of our recommended bonds report. So with that, over to Mr. Ang Chung Yuh.
Hi evening everyone. My name is Chung Yuh. Okay, thank you for joining tonight's webinar. I hope you and your family are safe and well in these unusual times. So if you have invested in the financial markets in the first half of this year, then you have known that we have been on a roller coaster ride. So our agenda tonight is to review what happened thus far this year and what that means for the rest of 2020. And after that, I will highlight a few bond ideas from the latest edition of our recommended bonds report. And we have also thrown in 2 additional bonds for this presentation that are not in the report. So there's a bonus for your attendance tonight. So just start with some background, which I think should be well known to most, if not all of you. Earlier in the year, global markets were continuing their upward climb after the US and China signed their phase 1 trade deal in mid-January. Then investors began to price in COVID-19, sending the market down its fastest trip ever into bear territory. Global markets reached their low on the 23rd of March, the same day when the US Fed announced a massive monetary stimulus program. And after that, risk assets started their biggest rally ever. And I think recovering at least half of their losses very quickly. So certain asset sectors of the market like US investment grade bonds and Nasdaq 100 have even exceeded their pre-virus levels. I think there are many possible reasons for this breathtaking market rise. I'll talk about some of them and the implications for our portfolio. Obviously, I think the major government actions in terms of monetary and fiscal stimulus have been an enormous contributor, boosting market sentiment and financial conditions. So as you can see on the right here, financial conditions improved very quickly across the world from the brief tightening in February and March. Now, although I agree with the consensus that quick and decisive government actions are needed in this crisis, I'm also concerned with the possible side effects from ballooning government deficits and debts. This chart on the left shows the rapid growth of major central banks' balance sheets as they're used to finance the government's fiscal measures. Well, maybe I'm not modern enough. I'm not convinced by the recent modern monetary theory that basically says a country with its own currency never needs to worry about deficits. Another factor that is widely expected by most people is that interest rates will be lower for longer, with central banks like the Fed already stated that they will keep rates low through at least next year and possibly 2022. So this is a good thing for bond investors, but one thing to note is that with most sovereign yields approaching zero, I think their hedging benefits are becoming increasingly limited. So even conservative investors should be careful not to put too much of their portfolio into government bonds. Just now I've mentioned that financial conditions have improved a lot since March. So combine that with explicit support from the Fed for corporate bonds, and we have seen a record level of bond issuance in the US, with most deals heavily oversubscribed. Although this is good for the market in the short run, because even money-losing companies will be able to refinance and stay alive, again, I think the longer-term ramifications are harder to tell. Because in previous crises, what we typically see is a deleveraging in the corporate world. But this time around, I think the opposite is likely to happen, and we might have a case of lenders willingly financing zombie companies and rising defaults down the road. On the Asia side, things are looking a lot more reasonable, with the issuance volume only seeing a strong rebound in the last couple of months. Here I've used offshore Chinese bond issuance as a proxy, as they make up the biggest part of the Asian market. And back in Singapore, things are a lot more quieter. SGD new issue volume fell by close to 40% in the first half of this year. This chart on the right shows the breakdown in issue quality based on Bondsuper's classification, as the SGD market is mostly unrated. So most of the 17% new high yield bonds, which is the red slice, were actually launched before COVID-19, with only 4 high yield bonds issued after February. The biggest issue size was just 65 million. So that tells us possibly 2 things, one good and one bad. First, SGD investors are still highly risk averse, which is usually good for valuation and prospective returns, because when most people are scared, investments are usually cheap. But second, the number of high-yield SGD bonds have continued to become lesser, which is bad, as we'll find more and more difficult to find good high-yield choices. In terms of fundamentals, I think we all know that most economies shrunk in the first quarter and most likely the second quarter as well. In fact, our own Singapore just reported a record-breaking 41% drop in GDP, officially going into recession. So if you think about it, the world is fighting the greatest pandemic as well as the worst economic downturn in our generation. But financial markets overall are not far from where they were before the crisis hit, when the economy was still looking good. And how is that possible? So there are a number of frequently cited reasons for this disconnect, and I'll talk briefly about some of them. One major argument supporting the great rally is that the market is forward-looking, and the consensus out there is that the global economy will see a recovery starting in the second half of this year. You probably have heard pundits talking about whether the recovery will be V-shaped, S-shaped, or whatever. But broadly speaking, I think most people think that the economy will start to recover in the near future, or in the case of China, has already started to recover. I agree with this consensus, but I do have some concerns about the trajectory and the speed of this recovery, which I'll talk more about later. Another factor frequently cited by optimists is that the market recovery has been spearheaded by the tech sector, which is supposed to be shielded from the crisis and might even benefit from it. But I personally find it difficult to understand how tech can continue to grow at the pace that the market expects it to, when at the same time the rest of the world is coping with deep recession. And recent relative returns between tech stocks and the rest of the market have reached a level not seen since the dot-com bubble. So I think there are some grounds for caution. So what are the potential factors that could spoil the party? I think the number one concern these days is the possibility of a second wave of COVID-19. And we have seen that, for instance, in Hong Kong recently, where the government was forced to reimpose restrictions after a spike in infection cases. My own view is that governments are unlikely to go back to their strictest lockdown measures, even if there's a second wave, because now that we have seen the devastating economic impact of such measures. And also the world should be better equipped to cope with the health crisis now. But I think regardless of government policy, if the overall population is worried about the virus and hence avoiding shopping malls and restaurants, then the economy will still suffer whether there's a lockdown or not. The second downside risk to the global economy is the risk of a bumpy route to recovery. And I'll talk about China as a case study here because it is one of the few countries that have already returned to growth in the second quarter. Although we are positive on China, we need to note that much of the country's momentum was coming from what we call a state-driven industrial activity, with consumer spending remaining weak, as shown on this slide. So I think the recovery in China is likely to be gradual and uneven, especially when the country's major trading partners like Japan and the US are still struggling with the virus. Globally, we are also seeing higher levels of financial insecurity among consumers. These two images are taken from a YouGov survey across 26 countries and are reported by Bloomberg. But broadly speaking, the surveys tells us that households everywhere are now more concerned about their jobs and their financial situation. So most likely that many people will cut non-essential spending and invest less, and that could slow the economic recovery. Finally, we are seeing the re-emergence of geopolitical risks as various concerns fade. Like for instance, the deteriorating US-China relations, North Korea conflict, and a rise in populism and nationalism. What these events do is they add to the tail risk facing financial markets. And overall, weighing all these factors, including the recent performance of market, valuations, and the economy, I agree with the market consensus that the fundamental outlook is positive on balance. But what I disagree with is the valuation of most risk assets, because I think overall investor attitude today is somewhat too relaxed and valuations have not sufficiently priced in tail end risk. So I think we should be more defensive in our portfolio allocation. Having said that, I think being defensive does not mean we should avoid the market altogether. Instead, we should focus on valuations and insist on reasonable risk return. And at the moment, a number of asset classes are still deeply discounted, both relative to history and other sectors, like for example, Hong Kong equities and Asian bonds. So this chart shows the valuation of Asian bonds versus their US counterpart. And even after the recent rebound, Asian corporate bonds still offer attractive spreads that are much higher than the historical average, especially Asian high yield, as their premium over investment grade is close to 2 standard deviations above historical mean. On the other hand, I think US IG is a bad place to be in. Although they enjoy the support from Fed, I think their spreads are just around the long-term average, which is as if the virus never happened. So I think the market is putting too low a probability of rising defaults in the US. The chart on the left here illustrates the sizable spread pickups that Asian bonds offer over other fixed income sectors like the US and Europe. Although some near-term weakness is expected, given the economic damage from the virus, it is important for us to have a long investment horizon and invest when yields are attractive. This is because yields are a reliable predictor of the eventual return from a bond portfolio. The chart on the right shows the yield at the start of the 5-year period and the subsequent total return 5 years later. What it says is basically if you invest in a diversified bond portfolio yielding 5%, you should get around 5% return over the following years. But of course, the caveat thing is that your portfolio needs to be well diversified. And besides attractive valuation, the credit metrics of Asian issuers are decent compared to their peers. As we can see from the left chart, Asian high-yield issuers have financial leverage that's on the lower end of the spectrum versus other fixed income segments. And on the right, we see that the average gearing of Chinese developers is on a downtrend in recent years, although the median number is rising. So most likely what this tells us is that the financial health of highly leveraged developers is improving, which is good for the high-yield sector. So just to quickly sum up this section, my opinion is that overall, the market environment today is on the relaxed end, and valuations of risk assets do not fully compensate for the risk of such as disappointments in the economy and corporate earnings. Nonetheless, there are still asset classes that are offering attractive valuation, like Asian bonds and especially Asian high yield. But because of my caution toward the market environment, I think credit selection is more important than ever, meaning you should take more care in choosing your investments and making sure the risk return is appropriate. I've come to the second half of this presentation to highlight 8 of our favorite bond ideas. This first bond is from Logan Group, previously known as Logan Property. It is a Chinese developer with more than 80% of its land bank in the Greater Bay Area, which is the region that covers Guangdong, Hong Kong, and Macau. The company is listed on the Hong Kong Stock Exchange with a market cap of around HKD 80 billion. We are positive on the company's outlook for a few reasons. Firstly, I mentioned just now, most of its developments are in the Greater Bay Area, and this region is likely to grow fast because of government initiatives to build into a world-class economic cluster. Second, Logan has a healthy credit profile and strong growth prospects relative to its BB credit rating, and its sales have been resilient even amid the pandemic. This slide shows the breakdown of Logan's projects. Besides the low cost and profitable land bank as shown on the right, which is mostly in the Greater Bay Area, the company also has a strong pipeline in what we call as urban renewable projects on the left, which carry high profit margins. As we can see that after the downturn in February due to coronavirus, Logan's contracted sales have rebounded strongly since then. And year-to-date June, contracted sales were actually slightly higher than last year. The average selling price of its properties has also been broadly on an upward trend. In terms of its credit profile, the company has been rather aggressive in land acquisitions, so that constrains improvements in its credit profile. And in line with the growth of its scale, total debt typically increases every year. But overall, the level of borrowings relative to the company's earnings and total assets is still healthy for a BB company. We think Logan's US dollar bonds are more attractive, but if you invest exclusively in SGD, this April 2021 bond still provides decent value at around 4% yield for an 8-month tenure, even after the strong rally since March. The next bond is a more conservative choice from Fraser and Neave, a company that most of us are probably familiar with, being one of the leading F&B players in Southeast Asia. So F&N has been overall a steady performer in terms of its financial results and business growth, with slowing growth in its beverage business offset by progress in the dairies and alcohol segments. In particular, the dairies business has grown to become the group's largest profit generator. And with most of its products being consumer staple goods, we expect the business to be resilient against the global economic slowdown. In any case, F&N's strong balance sheet provides the cushion for it to tide through near-term headwinds, and the sector's short cash conversion cycle should ensure sufficient liquidity for the foreseeable future. The beverages business of F&N has been overall on a declining trend, mainly because of intense competition in the sector and I think rising health awareness on sugar consumption. But we have seen some improvements in recent periods after the company shifted its focus to areas like Starbucks and alcoholic drinks. And F&N's growing dairy segment has anchored its earnings with an overall steady performance in the latest half year ended March. As shown on the right, the group's geographical exposure is fairly diversified across the ASEAN region. In terms of its credit profile, F&N has little debt and a low gearing level, so that translates to a strong interest coverage because of the company's stable earnings. Besides that, operating cash flows have been consistently positive over the years, and the company typically maintains a comfortable liquidity position relative to its debt servicing needs. The F&N bonds stand out in the SGD space because they offer a rare diversification opportunity into the F&B sector. This 2022 bond yields around 2.1%, which translates to a decent spread of more than 180 bips. And 2.1% may sound low, but it's actually a good return for high quality corporate issuer and just around 18 months remaining maturity. The next bond is a US dollar bond of Seazen Group. This is a top 10 property developer in China, previously known as Futureland. Management focus has shifted to financial prudence since last year, slowing down their land acquisitions, and the company has plans to divest up to 15 billion RMB worth of projects. But it still has a huge land bank, enough to sustain at least 3 to 4 years of sales. And as a tier 1 developer, the company's business is very well diversified in terms of its geographical exposure, covering I think 105 cities across China. So Seazen stands out among Chinese property firms because of its fast-growing rental business, with rental income quadrupling over the last 2 years. And if we include fees earned from managing commercial properties, we estimate that recurring income contributed close to 20% of operating income last year. We also like that the group has shifted to a more conservative financial philosophy following a management transition last year, with a gearing ratio that's among the lowest in the sector. And among the Chinese developers that we track, I think only 2 investment-grade issuers have lower leverage than Seazen. Seazen is a double B rated company, and we think the company's credit profile is healthy among peers with similar ratings. This 2023 bond is yielding close to 6%, which is a good return versus comparable bonds. Next, we have a SGD Perpetual bond from Mapletree Logistics Trust. MLT is a logistics REIT sponsored by Mapletree Investments, a subsidiary of Temasek. It has a highly resilient portfolio with a well-staggered lease expiry profile of around 4 years and a healthy occupancy rate of 97%. It is among the few REITs that reported strong growth in the second quarter this year, with higher revenue and net property income despite COVID-19. And one factor that we should pay more attention to when we invest in this environment is the liquidity of a company. And in this regard, MLT has a comfortable liquidity position with enough credit facilities to refinance all debt maturing in this and next year. MLT has a diversified portfolio of assets across 8 countries, including Singapore, China, Japan, Malaysia, and South Korea. Another factor supporting MLT's portfolio resiliency is the diversification of its tenants, with close to 700 customers across various trade sectors, and the top 10 tenants contributing less than 30% of revenue. And finally, with its healthy balance sheet and a well-staggered debt maturity profile, the REIT has an investment grade rating of BBB. This perpetual bond is callable in November 2021 and has a yield to call of around 3.2%. Although there are some concerns about extension risk or non-call event due to the low interest rate environment, we think it is unlikely for the current crisis and economic downturn to extend until next year. And MLT's assets, which are logistics focused, should be more resilient versus other property types, such as shopping malls. Next is the 2022 SGD bond of ESR Cayman, the logistics property company that IPO'd in Hong Kong last year. I like that close to 60% of its assets under management are located in China, Singapore, and South Korea, where the governments have been relatively more successful in containing the virus. Also because its portfolio is predominantly logistics properties, and more than 60% of its tenants are in the e-commerce and logistics sectors. So far, there have been minimal disruptions to its business. Furthermore, we expect the virus outbreak to accelerate the trend of online's rising share of worldwide retail sales, hence driving demand for logistics properties. Asia is the fastest growing e-commerce region, and China is the biggest market in terms of total online retail sales. So if most of its tenants in the e-commerce and third-party logistics space in Asia, I think ESR Cayman has good growth prospects despite macroeconomic headwinds. I also like that ESR Cayman generates a substantial portion of earnings from its fund management business, which has higher margins and lower capital requirements. If we exclude fair value gains from the investments and development segments, the fund management business generates about 40% of the company's operating profit. ESR Cayman has both Sing dollar and US dollar bonds. Again, in this case, the US dollar bonds offer better value in our opinion. But if you invest in SGD only, these 2022 bonds still gives good return among real estate names in the Sing dollar space. The next bond is from Singapore's largest real estate company, CapitaLand Limited. So after the acquisition of Ascenda Singbridge last year, I think the company is more than 3 times bigger than City Developments, which is the second largest property developer in Singapore. Besides its leading position in the Singapore and Asian markets, CapitaLand enjoys good access to capital markets because of its linkage to Temasek, which is a majority shareholder of the company. And a substantial part of its asset portfolio earns recurring income, so that supports its interest servicing ability. As can be seen here, CapitaLand has grown over the years to earn most of its revenue outside of Singapore, with a property portfolio that's well diversified across various sectors, including residential, retail, commercial, and hospitality. Similar to most other Singapore real estate companies, CapitaLand's credit metrics weakened in the first quarter of this year. But overall, its financial health remains good, with high interest coverage and a net gearing ratio that provides ample of debt headroom for liquidity needs and growth opportunities. CapitaLand has cash and credit facilities totaling 13 billion, which is enough to cover borrowings maturing over the next 3 years. And the debt maturity profile is well staggered with a weighted average of 3.4 years. So overall, it is in a comfortable liquidity position. This CapitaLand SGD bond matures in 2024 and has a yield of around 2.2%, which may sound low, but that's because interest rates are a lot lower now than before. So bond yields are also generally lower. But if you look at credit spreads instead, this bond is giving about 170 bips above benchmark rates, which is more than 50% higher than pre-COVID. We have reached the last 2 bond ideas, which are not inside the recommended bonds report because you only recently highlighted them after the report is already written. And the first is SGD Perpetual Bond of Ascott Residence Trust, which is a leading hospitality REIT in Singapore. So if you have invested in a REIT before, you probably will know that it's important to know who is the sponsor of the REIT, as that often plays a big factor in terms of the risk, asset quality, management, corporate governance, etc. And in this regard, Ascott Residence has a strong sponsor, which is CapitaLand, the company that I've just talked about. I think many people might be cautious about investing in a hospitality company when this sector is obviously suffering from the ongoing health crisis. But when we are investing in the bond, we don't necessarily need the issuer to prosper. We just need the company to survive. And Ascott REIT certainly has the financial firepower to tide through this crisis with a much bigger operating scale than its peers, high interest coverage, manageable gearing, and ample financial liquidity. Furthermore, we are starting to see improving operating conditions for hotel operators, although I think the outlook is definitely still challenging. More and more countries are starting to open up their borders selectively, and in most places, hotels are considered as an essential service and used to accommodate healthcare employees or people under quarantine order. When border restrictions are further lifted in the future, we expect Ascott REIT to outperform its competitors because of its more diversified portfolio with 88 properties across 15 countries. This perpetual bond of Ascott REIT was in the headlines back in May when it was announced that the REIT wouldn't be calling back the notes, choosing instead to let them reset to a much lower rate of 3.065%. And the market response obviously wasn't positive. But we think at its current price of low 97, the risk reward is attractive. And given the strong track record of its management and the sponsor, we expect Ascott REIT to redeem this perp eventually when operating conditions and cash flow normalize. And even if we assume the downturn is prolonged and drags on until 2022, a buyer of this perp at current prices is still looking at a potential yield to core of around 4.7%. 4.7%, yes, which is pretty good. My last bond recommendation is another SGD bond from Metro Holdings. I think most of you who have heard of Metro probably are under the impression that this is the local shopping brand operating retail department stores. But nowadays, retail actually makes up the smaller part of its earnings because today Metro is more of a property investment and development group. Metro invests in its properties mostly through joint ventures and associates, and over the years, the company has built a presence overseas in countries like Indonesia, UK, Australia, and China. We like this credit primarily because the company's gearing is low relative to the yields that we can get from its bonds. Although Metro's financial leverage has gradually increased over the years as the company shifted its focus away from retail and towards real estate, overall the level of borrowings is still low. In addition, all of its borrowings are unsecured, so that should give the company a lot of flexibility to raise secured debt if needed. And it has a comfortable cash buffer that is sufficient to meet all near-term borrowings and other financial payables. At 3.5% yield, this Metro 2021 bond is giving substantially higher return than before COVID-19. And we think it is a good choice among higher yielding real estate names in the Sing dollar space. This table lists down the 8 bonds that I've highlighted, and I think that's the end of my presentation. Thanks again for joining us tonight.